Hi, and welcome back again to Tim Bigham's Big Time Options, Edges and Hedges. Be taking a look at our UOA today. Some unusual option activity, to say the least, on Progress Software, PRGS, and two trades to follow the big call buyer and capture the vol in PRGS. So let's jump in and take a look, shall we? First of all, here's the scanners I use. This is the one kind of that is pre-defined out there. So Progress Software showing up number 4 on the list, as you can see, over 17,000 options traded versus less than 1,000 average volume, more than 25 times the normal volume. You can see the implied volatility shot up to the highest level over the past year. So unusual option activity, to say the least. Here's the same type of scanner I built on Thinkorswim. You can see progress, the March 45 calls, right, where most of that volume came from, almost 8,000 contracts traded. So PRGS showing that big UOA, especially on the call side. We'll take a look at that in a second. We always like to look at, the kind of the fusion approach when we're putting together a trade, looking at fundamental, technical, and IV analysis. So from a fundamental side, you can see that Progress Software pulling off a 5-year PE chart at about the cheapest level it has been, certainly over the past 5 years. Bounced off of that 20x level, was there briefly back in mid 2022. So certainly valuations getting cheap, price to sales at the lowest level we have seen over the past 10 years, at less than 2 times price to sales. So Progress Software getting cheap, certainly on the traditional valuation metrics. You can see earnings, right? Last earnings report came out January 20th, right? They beat yet again. The past 4 earnings have been a big beat, right? So 4 straight earnings beat, yet the stock is trading at the lowest level of the year. Low price of the stock combined with higher earnings leads to lower valuation multiples, as we have seen here. On a technical basis, you can see Progress Software bottomed out at that 35 level, right? Here were the earnings, right? The stock chopped around, had the big tomahawk chop, right, as it broke to fresh new yearly lows, which may have led to a lot of kind of just get me out sort of selling. You can see 9-day RSI hit that 30 level again, but has strengthened, right? MACD reached a recent extreme, but is firming up. Bollinger percent B went negative. Shares were trading at a big discount to the 20-day moving average, but now right back at it. And probably most importantly, we'll take a closer look. Implied volatility, even post earnings. Normally, you see that earnings crush, which we did here, but now IV at a higher level than it was pre-earnings. So option prices getting certainly expensive here. How expensive? Took a look at the 30-day IV. You can see here is that spike based on that big unusual option activity, right? All that big buying out there, call buying especially, where we saw almost 18,000 contracts trade versus less than 1,000 normal sort of volume, with IV just absolutely going to the moon here. So IV exploded, which means option selling strategies certainly can be favored here. You can see, especially on the short end, right, that IV from Thursday to Friday's close absolutely jumped here. Took a look at the kind of 20-day generalized IV. You can see it was hanging below that 60 level, certainly mostly in the upper 40s, low 50s. Then Friday's big unusual option activity, right, put IV to over 70, setting up ideally for a couple vol capture trades to lean with that big call buying out there. You can see the March option showing the preponderance of the volume, over 14,000 trading there, as we saw on the scan, right? The big volume was in the March 45 calls with almost 8,000 contracts. You can see overall calls over 17,000 calls traded, about 300 puts. So calls far outpacing puts, right? The call sizzle index over 4, put scissor index still well under $1. Here is a month-long look at the slightly out of the money, kind of 25 delta 30-day call, and you can see now trading at the highest IV level by far over the past month. Sets ideally for a couple of vol capture trades that lean bullishly with that big call buyer out there, but more importantly, capture that vol. So we're going to take a look at two simple trades. One, a simple covered call trade, right? Buying the stock, selling these now very expensive calls. So I pulled off, the close on Friday here, as you can see, versus going back to February 12th. So on February 12th, the stock closed at 40.95, right? And this is before we saw that big deluge of recent call buying, right? Where IV was much lower. That March 45 call trading just over a buck at 105, right? You can see the buy right, which is simply to buy the stock, sell the call, trading 39.90. The IV on the call just under 47 at 46.97. 36 days to expiration back then on February 12th. And the call delta, and this is something that I think is very interesting, was 30. We're an out of the money call, right? The stock just under 41. That March 45 call with a 30 delta. So your buy right delta, which would be 1 minus 0.30, you'd have a 0.70 buy right delta, if you will. So you'd be bullish but less bullish by selling that call. Have plenty of upside, about 10% right between 41 and your 45 short strike price. Fast forward to Friday's close, where we saw here's that big 77.98 call buying out there, right? And you see volume on several of the other nearby contracts, right? So the stock closed at 40.33 on Friday, right? Which is lower by over 60 cents from our previous date that we looked at, February 12th. So the stock has dropped 60 cents, yet the March 45 call with the stock dropping 60 cents actually went up in price by about 90 cents. So it closed at $1.93 back then. It was trading at 105. So you see the stock down 60 cents or so. The calls up almost 90 cents. So the stock down, calls up, sets up ideally for a buy right to buy the stock at a cheaper price, sell the March 45 call at a much more expensive price, only paying 38.41 for that buy right back then with the stock higher 39.90, right? So you can see that huge call buying sets up ideally lean bullishly with that call buying out there. Why did these calls go up even with the stock going down? IV now exploded to over 80 right back here. It was under 50, so a massive jump in IV, right? And no 2 days to expiration. Back then we had 36 days to expiration. On Friday, only 27. So normally you'd have time decay. You'd have the option price drop as a function of time as well. So you have a shorter term option with the stock price lower, trading at a higher price than it was even post earnings because of big unusual call buying, right? And note too that the call delta, even with the stock lower and time passing, is now at 36, right? It's further out of the money with a higher delta. Back then it was 30. Why? Because you saw that huge jump in implied volatility, right, to 81. So that pulls the absolute value of deltas towards 0.50. So interesting to note that the trade would only be 64 deltas net long now, even with the stock lower, right, and more upside. So interesting, but a way to take advantage, certainly, to capture the implied volatility spike here, right, and lean bullishly with the call buyer. Another trade to consider, right, and I went back to February 4th on this one, is selling that March 45 straddle, right? So the stock back on February 4th was just over 40 bucks at 40.05. That March 45 straddle closed at about 688, right? The IV on it, right, taking the average of the call and the put, we're hovering right around that 47.48 area, 47.75. The delta on this, right, you're selling an in the money put, right? You're selling the 45 put which is in the money by almost 5 points, right? Selling an out of the money call. So you'd definitely be bullish, right? You'd be 45 deltas net long, right? Selling a negative 73 on the put side, selling a 28 on the call side. Days to expiration, 44. Fast forward to Friday's close, you can see the stock versus our date back on February 4th actually went up in price a little, right? 28 cents, closer to the 45 strike price. So you'd certainly consider expect the straddle to cheapen in prices, moving towards the ideal price, which would be 45. Plus, you have much less time till expiration, right? Back then, you had 44 days. On Friday, only that 26 days. So time decay. But lo and behold, you see that March 45 straddle actually jump higher, right, to over $8. Back here was trading under $7. Why? Because the huge spike again in IV over 80 now, right, on the sell straddle, right, where it was under 50 back then. So it's a way to lean still bullishly, right? Your delta would be about a 30 delta still. You'd still be bullish. So you'd be selling a negative 65 on the put side, selling a roughly negative 35 on the call side. So you'd roughly be 30 deltas net long. So still leaning bullishly with that big call buyer out there, but capturing this massive jump in IV here. So a straddle that went up in price, even with the stock moving more towards the beneficial short strike price of 45, even with days to expiration dropping by 18 days in this case. And the reason, because IV exploded because of that UOA call buying. So hopefully it provides some insight how we go about identifying some straightforward trades to go lean bullishly with that unusual option activity. In this case, the call buyer, capture the fact they're paying way overpaying for the calls and lean bullishly with it and look for that IV to revert back once that big unusual call buying subsides. But as we always say, trading is about probability, not certainty. So still make sure you position size appropriately, know where to get out, right? Or at least trim down the position. If you don't know where to get out, you shouldn't be getting in. So until next time, as always, here's the good trading.